Hello students, welcome to JMC Learning. Today we are discussing the first session of grade 11 of this series, the lesson in your textbook, Adjustment Entries with Financial Statements, which is the first lesson of our second term. So, we'll start by discussing adjustment entries. What are adjustment entries? I'll tell you like this. When we are making financial statements, now you have already learned two financial statements, the statement of trading profit or loss and the statement of financial position. Financial statements are the output of our accounting process. So, out of these statements, trading profit or loss, this statement records the income and expenses of the year and the profit generated by a business. And the statement of financial position, on the other hand, discusses how much of assets, equity and liabilities are there in a business. Simply, the statement of financial position depicts the accounting equation. So, adjustment entries. Adjustment entries are required because of some businesses and all the businesses are using some assumptions or concepts when they are recording transactions. I'll teach you a few. Basic concept we are using is business entity concept. Business entity concept. In this concept, we assume business and the owner are two separate parties. Business and the owner are two separate parties. These two has nothing in common, but this person, owner, has the ownership of the business. That is why we are recording drawings and additional capital as separate things. So, in the business entity concept, we believe owner and the business are two different things. If the owner takes business money for his private use, we record it as drawings, not the business expense. That is the meaning. And if he takes money for something else, that is also we record as drawings. And if he introduces capital, we also record it as capital, not as any other income of the business. So simply, business entity concept means owner and the business are two different, separate, independent entities. The other one is going concern. Going concern concept. Going concern means we assume our business will continue to a foreseeable future, not an infinite future, not a future that we can't see. The business we assume will continue to a future that we can see. 5 years, 10 years, 20 years, like that. A time period that we can predict, forecast, like that. Then, the third concept we are using most commonly, almost all the businesses, periodic concept. Periodic concept. What is this? Periodic concept. Because of the periodic concept only, we are making financial statements for a certain accounting period. Periodic concept means we have to record financial information to a certain limited period, and we have to include all the transaction in that period. So, the fourth concept is the most relevant concept for lesson, adjustment entries. The fourth concept is accrual basis. Accrual basis, or you can call accrued concept. Accrual basis. What is this accrual basis? Accrual basis says we have to record all the income and expenses that taken place during a certain period, most probably the accounting year, without considering the cash payment or receipt. Simply like this. If we have income and expenses during a year, we have to record it without considering, irrespective of cash receipt and payment. Example, we have, let's say, a fixed deposit. We have a fixed deposit, then we get an interest of 5,000 per month. 5,000 per month. So, in this year, we only receive fixed deposit for 8 months. That means interest we receive only for 8 months. And we didn't get for 2 months. We have to get it, but we didn't get it yet. So, 8 months, 5,000, we received 40,000. But for the year, as a total, how much should we receive? More. We have to receive all in total 60,000. 5,000 into 12 months, we have to receive 60,000. But we only receive 40,000 for 8 months. Which value should we record? According to the accrual basis, we have to record this 60,000 in our profit or loss statement under other income. Why? We have earned this during the year. During the year, we have already earned this, although we didn't get money. So, according to the accrual concept, we have to record all the income and expenses relevant for the year. We earned or we spent. We are liable to spend during the year without considering whether we got or we paid cash. To adjust this, now when we are taking this example, in our accounting records, only this amount is presented. Why? It is received in cash. When it is received in cash, we have passed the double entry already. Cash account debit and interest income account. Interest income account credit. We have already passed this. But what will happen to the rest 20,000? That is also something we have to receive, something we earned. Therefore, we have to adjust this 40,000 with this 60,000. The actual amount should be recorded is 60,000 because we have earned this 60,000 during the year. But we have recorded only the amount we received in cash. There's a 20,000 left we haven't recorded. to record that 20,000 is where we need adjustment entries. To adjust this 40,000 should be adjusted to 60,000, the actual income we earned. So, in this lesson, we have to talk about mainly 4 adjustment entries. Those are: number 1, accrued expenses. Number 1 is accrued expenses. Next, income receivable, the example we discussed now. And third is bad debts. Last, depreciation. First of all, let's discuss what is accrued expenses. Accrued expenses are simply expenses that we have not paid yet. That means we have already obtained the service or consumed it, but we haven't paid yet for it. For example, electricity. We have enjoyed electricity facility or the electricity service for all 12 months. But we have only paid for 7 months. How many months left? 5 months. But for that 5 months also, we have already consumed the service. We have to pay it. We are liable to pay it. Such expenses, we have already consumed the service, but we haven't recorded it yet or paid it yet. The services we have already obtained but not paid yet, or simply expenses which we haven't paid for yet, is called as accrued expenses. Expenses to be paid but still not have been paid. So let's take an example to explain this. If you need notes for this, in your study materials, the definitions and explanations are there. You can download it and you can check it for yourself. So let's take an example. I'll take like this. Salary. Salary. I have an employee. I'm paying 20,000 per month. I'm paying 20,000 per month, but I have paid only for 10 months. Normally, for an accounting period, we have 12 months. So, I have paid 10 months for the employee, but the employee has worked for 12 months. He have given his service for 12 months, but I haven't paid him yet for 12 months. I have paid him only for 10 months. So, 20,000 per month for 10 months I have paid. First we will calculate the liable amount. Expense. Salary expense. Salary expense for the year. How to calculate? 20,000 into 12 months. All in total 240,000. I am liable to pay this amount, but I have paid amount only for 10 months. 20,000 for 10 months. I have paid 200,000. What is the rest? The amount I haven't paid yet? Accrued salary expense. Accrued salary expense. With accrued, always remember, haven't paid yet. So, the expense is 240,000. I have already paid 200,000. Then the accrued salary expense is rupees 40,000. I have an employee. I'm paying him 20,000 per month and I have only paid for 10 months. Now I calculated for the year I have to pay 240,000. I have only paid 200,000 and I'm liable to pay another 40,000. My students, this amount is a liability for me. This is a liability. I am bonded to pay that. I have agreed to pay that. And I have to pay it any day in the future. In a future date, I have to settle it any day. At the settlement, my cash will go outside. My resources will flow outside. And this is a liability because I have already consumed or enjoyed the services provided by my employee. Let's say he is an accountant. He has already made my all reports and everything. So I have already obtained his service, but I haven't paid it. So I am liable to pay to him. So accrued expenses is always a liability. So we'll see how to record this liability in ledger accounts. So for that, first you can record the cash payment. There are three aspects of this transaction. Salary expense. Salary expense, there are three aspects. One, expense for the year. Expense for the year. Expense relevant for the year. The other one, paid salary amount. Salary paid. The other aspect is accrued salary. Accrued salary. I have some amount I am liable to pay for the whole year. I have agreed with him. That is 240,000. But I have paid 200,000 out of that. And I have to pay another 40,000 for the rest of his service. So, this amount, salary paid, we can record it quick and easily. What is the double entry? We have paid already. Therefore, salary expense account debit by 200,000 and using cash I have paid, therefore cash account credit by 200,000. rupees. And this accrued salary. Salary expense is something we are liable. So, anyhow you have to pay it. So, salary expense. Salary expense account again debited. It is relevant for the whole year. Debit with the accrued amount 40,000. This is relevant for the whole year, even we paid or not. And the other entry, where's the credit entry? We have to open a temporary account to record the amount we haven't paid yet. That is accrued salary expense account. It is a liability, therefore it is credited. Rupees 40,000. This is the double entry for accrued salary. Salary expense account debit, because that salary amount we have to pay it anyway. And accrued salary expense account, it is a temporary account to remind us, you haven't paid that amount yet. It's an alert. It's to remind us that we haven't paid it yet. Therefore, it's a liability. That is why it is credited. Then what is this? Expense for the year. Expense for the year is salary expense account. Here, salary expense account, salary expense account, debit, all in total 200,000 plus 40,000. $240,000. The credit entries goes to cash account and accrued salary account. There are three aspects. So, accrued salary, salary paid and expense for the year. After you pay this amount, this account will be cancelled. Now, let's see how that happens. Salary expense account. When we are paying in cash, cash account 200,000 and accrued salary, accrued salary expense account 400,000. Inside this account, as two line items, there is the total of salary expense for the year inside this. And the next account, cash account, cash account. Cash account is credited salary expense as 200,000. And the third account, accrued salary expense account. Don't mix up these two. This is salary expense account and this is accrued salary expense account. the salary account, we record the total salary relevant for the year. In here, we record salary paid. Here, we record accrued salary. Keep this in mind. These two are separate accounts. This is a temporary account to remind us. So, it is credited as salary expense 40,000. Now, I told you this is a temporary account. Why? Now, I am paying the salary for that employee. After the accounting year, I am paying the salary amount that I have to pay him. When I am paying the salary account, this is the double entry. Again, cash book or cash account credited as salary. 40,000, the rest 40,000. But we can't record in here because we have already recorded the total amount of salary expense. So, here the credit entry is salary 40,000. The debit entry goes to the accrued salary as cash 40,000. This means the remainder is over, we have paid the amount. What happens? The account is cancelled. So, this is the double entry to record accrued salary expenses. Accrued salary expense account credit, salary expense account debit. If you have any accrued expense, you have to record it as a liability. When you are recording it in the financial position, you have to record it as a liability. Financial position. Financial position. In here, under current liabilities, accrued salary expense 40,000. And the salary expense for the year statement of profit or loss if this person is relevant for sales activities, you record it under distribution expenses. You might have remembered it from their textbooks and everything. The people who are engaged in selling, marketing and distribution activities, their salaries has to be recorded under distribution expenses. Here, this particular example, this employee is an office employee. He is doing usual office work. He is not connected to sales. So, I am recording salary expense under administration. Administration expenses, salary. I have to record relevant amount for the year. This is the point accrual basis applies. Regardless of cash payment, in the profit or loss statement, we identify 240,000 of salary expenses. Otherwise, think if we record 200,000 here, by that we will reduce the expenses and we will show a higher profit. All at the end, we are providing wrong information to our stakeholders because Even though we paid or not, we have to incur 240,000 salary expense. But if we show here only the cash paid amount, that means 200,000, we are not showing a 40,000 amount of expense. So we have to provide correct information for the period, and that 40,000 also relevant for the period. We have to make the expense anyhow. Never mind it's from next year or year by next. We have to make it or pay it, but that expense generated in this year. Therefore, we have to identify salary total amount of 240,000 in our accounts. If I write the journal entry for that, the similar thing, journal entry will be salary account will be debited by 240,000, cash account 200,000, and accrued salary account 40,000. But here only we are recording accrued salary expense. Therefore, the double entry will be salary account debit 40,000, accrued salary account credit 40,000. So this is our first adjustment. I think you have a proper understanding. Accrued expenses. So accrued expenses, you have to remember, it's a liability. We have to pay it anyway. When we are recording it in financial statements, profit or loss, we have to record the total amount relevant for the year. And if we have a accrued salary or accrued expense amount, we have to identify it as a current liability under financial position. Now we are moving on to our next adjustment. The second adjustment, income receivables. Income receivables are also very similar to accrued expenses, but the opposite. That means we have already earned an income, but still we haven't received money. The first example I discussed, fixed deposit interest. And let's take another example. Rent income. Let's take an example like this. Rent income, we have rented the part of our business and we are charging, we'll say 10,000 per month. 10,000 per month. The people who are staying in our premises have to pay us 10,000 per month, and we have 12 months per period. But these people have paid us only for 8 months. Have paid only for 7 months. Now let's calculate what is the total income, income received and receivable. This total income. This is very easy, just like the previous example. Total income 10,000 into 12 months, 120,000. And payment, paid 10,000 into 7. I have changed it to 7. So 7 months. Then we have received 70,000. Receivable. They have paid for 7 months. Then we have to receive for 5 another months. Therefore, 50,000 has to be received. We have to receive 120,000 in total for this year. But we have only received 70,000. I'll change this to received, otherwise you will mix up. Paid means the people who are using our premises. That means we received 70,000. And we have to receive, receivable, 50,000. So, this total income is from rent income, and we have to record this accordingly, just like we recorded accrued expenses. First, we have to record received amount. First, we are going to record the received amount. Cash account, debit because we are receiving money, rent, income. We received 70,000, and rent income account, credit, rent income account. Rent income account, credit, cash, 70,000. And there is a receivable. The receivable also relevant to this income. Therefore, we record it as a receivable in rent income account. Rent, receivable, 50,000. Now you can see all together there is 120,000, which equals to our total income. To record this 50,000, we can't record this 50,000 in cash account because still we haven't received this money. Therefore, we are opening a temporary account. Just like accrued expenses, we are opening a temporary account, rent income receivable. Rent income receivable. In this account, we record it in the debit side, rent income account, 50,000. Now, why did we record this in this rent income receivable account? You might say the opposite entry is in rent income, it is mentioning that receivable, that is why. No, there is a reason. Why? This rent income receivable is an asset account. This account here is an asset account. That is why its balance coming to this side. This is an income account, this is an asset account because we have to receive it. It's like a debt. They have to pay us. Just like the previous example, we are liable to pay another party in accrued expenses. But in this case, another party, an external party is liable to pay us. Therefore, it is an asset to the business. So, how to record this receivable and total income in financial statements. That is our ultimate target. How to record, how to know, how to learn to record these transactions in financial statements. Now, first thing we learned accrued expenses, how to record it in the financial statements. Now, this financial position, we have to identify this receivable amount as an asset. Therefore, under current assets, we have to record rent income receivable is 50,000. And in the financial position, we record it as a current asset. Then, statement of profit or loss. Statement of profit or loss. In here, under other income, because rent income is not among the main income sources. Here the main income source is sales. So rent income is a extra alternative income source. That is why we record it under other income. Therefore, rent income. Rent income, you have to record the total amount based on the accrual principle. You have to record the total amount of 120,000 because you have already earned it but still not received. According to the accrual principle, we have to identify the total income relevant for the year irrespective of cash receipt. Therefore, we are recording rent income under other income, the total of 120. The journal entry for receivable amount, only for receivable amount, is rent income receivable account debit. How much? 50,000. Rent income account. Rent income account credit 50,000. Here debit and credit. So, you have to remember these main points. You have to record all the rent income relevant for the year under the profit or loss statement, identifying it as a other income. And you have to recognize this in the financial position, the rent income receivable as an asset and record accordingly. Then, our next adjustment entry is somewhat different from these two. Now you know how to account for accrual expenses and income receivable. The next adjustment we are going to learn is bad debts. Bad debts. First of all, let's see what is this. What do you mean by bad debts? So my students, businesses sometimes they sell goods and services on two bases. They are selling on two bases, cash and credit. Cash basis and credit basis. In cash basis, you receive cash at the moment. But in this credit basis, this is the part we are talking. Credit. As a result of credit sales, we are getting an asset. What is it? Debtors. Debtors. So, debtors have agreed to pay us back after their credit period is over. Credit period is the period we have allowed them to pay, like 3 months, 6 months, like that. But sometimes these debtors at the end of the credit period also do not pay our amounts. When they are avoiding payments, or if we didn't receive the payment by 1 year or 12 months, we have to inquire why they haven't paid us. If the reasons to pay or unable to pay are these: death. The person who took goods or services from us is dead, so he can't pay. Or bankrupt. Bankrupt. That means he has no money to pay. His business is going to close. And bankrupt. And disputes. Disputes. For example, I'm selling goods to a person. After some time, when I'm reminding him about my cash, when I'm asking him to pay me, he's arguing with me. He's arguing with me saying, your goods are not quality enough. Your price is not satisfied. This is not the brand I asked. Like that way, to avoid the payment, he's arguing with me. Those type of things we call dispute, a problem between two parties. Here, the problem is between me and my debtor. He is not paying me. He is arguing with me. Disputes. And dislike. Dislike, what is that? Dislike means my debtor do not like to pay me. He is refusing the payment. He is avoiding the payment. When I am asking money, he is saying, no, I'm not paying. Like that. Or difficult to find information. Difficult to find information. After I have sold goods, the person is nowhere to be found. He has gone abroad or he has gone somewhere far away. I can't find him. I can't find information about him to get my debt back. So, if the reasons to not to receive the amount they owe me, one of these things, my dear students, we have to forget about that debt. We have to consider that we are not getting it again. Therefore, we have to let it go. How can we let it go? We are calling that writing off. Writing off. Writing off as a bad debt. Therefore, the idea is here. The debts that cannot be recovered. I know for sure I can't get this amount back. The debts that cannot be recovered are termed as bad debts. If there is a bad debt in the business, we have to let it go, or in the other words, we call it writing off. We are removing that debtor from our accounts. How can we do that? Let's assume I'm selling goods worth of 5,000 to a certain person, debtor A. After 3 months of time, I'm getting a news. Mr. A is dead by an accident. So, I have to decide now my debt cannot be recovered. That means it's a bad debt. This 5,000 is a bad debt. Now let's record this transaction. Bad debt 5,000. Before it becomes a bad debt, it is my sales value of debtor A's account. Debtor A's account, it is the sales value. Now I have to remove this A from my debtors because now he is dead and he can't pay. So I have bunch of debtors. I have to remove A. I have to remove A out of my debtors. To do that, I have to cancel his account. To cancel his account, there's nothing I can do but to record bad debt. When I record his bad debt, which is the total amount of sales I made, bad debt. Now you can see the entries are similar, so his account is closed. Now I have to record this bad debt in the bad debt account, which is an expense account. Bad debt account, debit, debtor A. How much? 5,000. Now the double entry is complete. Bad debt here, debtors account, credit, bad debt, bad debts account, debit, debtor A. Financial position. How to record this in the financial position? There's nothing to record but to identify. Current assets. Under current assets, debtor is there. Debtor balance is there. When you record this debtors balance here, you have to remove bad debts. Now in this example, we don't have any other debtors because the only debtor I had was Mr. A, now who is dead. So I don't have any debtors right now. But if the business has other debtors with a balance, we have to remove bad debt amount. Let's say we have a balance of 10,000 debtors. Now Mr. A's amount has to be removed, 5,000 bad debt. So the remaining 5,000 will be recorded here. Why? When we had 10,000 debtors at the beginning, when it comes to the year end, 5,000 debtors are not there. If we showed 10,000 debtors here, our statement will be false. Actually, we have 5,000 debtors because Mr. A was dead. Therefore, you have to remove or reduce, deduct this bad debts amount from your actual debtors. Then, statement of profit or loss. In here, under distribution expenses, Under distribution expenses, why distribution? Selling and distribution, short form we use as distribution. Debtors are generated as a result of sales activity. The expenses relevant to sales activities are recorded under distribution. Therefore, bad debt is an expense which generated as a result of existing of a debtor. Therefore, bad debt. 5,000. Like that. Under distribution. Because it's relevant to selling and distribution. Journal entry for bad debts. As usual, we'll look at this. Debtors account and bad debts account. Bad debt account, debit. General journal. Bad debt account, debit 5,000 and debtors account, the personal account is credited. Debtors account. Watch where you put this apostrophe, because if you put it here, that will be all debtors. Here we have a particular debtor. Debtor is A. His account is credited. So bad debt is originated as a result of doing credit sales. When the debtors are unable to pay, we have to identify that amount cannot be recovered. Therefore, we have to make necessary adjustments, and we are calling that writing off. Writing off can be done by cancelling the debtors account and recording it as a bad debt. Then we have to show in here debtor balance accurately after removing bad debts, and statement of profit or loss, bad debt as an expense. Journal entry. So my students, today we discussed major 3 adjustments in your textbooks: accrued expenses, income receivable and bad debts. So accrued expenses are the expenses that we have to pay, but we haven't paid until the end of the accounting period. Income receivable are the income that we should receive at the end of the period, but still we haven't received. Bad debts are the debts that cannot be recovered from the debtors. So now you have a good knowledge about how to record these transactions. So we'll meet in the next session. That session we are going to discuss about depreciation and adjusting these entries to financial statements. Thank you.